tough question because the global economy is going through uncertainty. Uncertainty is never desirable by investors anywhere, whether financial institutions or individual investors. But this is not new. The global economy has been rather resilient in the past also. And just cite two quick examples. The global financial crisis led to trust in the international monetary system, which was questioned. But we were resilient. We learned some lessons from it. A bigger event took place in 2020 when the pandemic and COVID-19 hit us, and Mother Nature told us that the world is very vulnerable to these kinds of shocks. But we were resilient and we came up with innovations and adjustments. Financial institutions did. Technology was a key driver to this particular area where we adjusted our lifestyles to ordering food and adjustment in our own office environment hours, working hours. So these are not new in terms of shocks to the international monetary system. However, we have to learn some lessons from it. Exogenous shocks must be adhered to ensure that central banks and financial institutions do not compromise on financial inclusion and sustainable growth. That's critical for our future planet, not only for the global south, emerging market economies, but the whole world itself. So exogenous shocks are something we need to be aware of, and we're preparing for it already. Example again would be the ASEAN region, which is only about 24.5% integrated, whereas Europe and the United States are 65% integrated. So that process is now taking place where integration by the ASEAN region is taking place. Regional economic trade patterns, RCEP, and others are being formed to prevent themselves from these exogenous shocks and protect themselves from their domestic economies. So I see uncertainty prevailing, but change taking place in adjustments by technology and the central bank regulations that have to be changed to accommodate that.
What kind of changes you're talking?
Well, the engine of growth of any economy is infrastructure. And infrastructure was decimated after the global financial crisis, where central bank regulations essentially prevented long-term assets to be put on the books of financial institutions, particularly the large ones, systemically important financial institution ones. So as a result, the economy of any country relies on infrastructure. During that time, the banks decimated their long-term asset talent also. So only a few banks currently remain who have expertise in those kinds of project finance analysis for long-term investments. That needs to be restructured. And central banks as regulators must come to the occasion to adjust their tier capital guidelines, to provide lower capital guidelines to those institutions that are AAA rated. Co-financing with multilaterals, say the World Bank, AIIB, and others, Exim Bank credits. Those are AAA rated entities, so capital requirements should be lowered. And also shareholder value needs to be understood by investors, because long-term value is what shareholders look at. And once you have that tier capital adjustments made, then you have access to finance. Unleash the huge amount of trillions and billions of dollars that are sitting on the sidelines with asset managers. And today, the younger people are socially more responsible. They want to be more invested in areas that are suitable for sustainable development and growth. So that's the way I see central banks playing a role.
What about this involuntary dependence on the cues coming out of the Feds?
Can you be more specific on that?
Amongst global central banks when it comes to policy making.
Okay, well, I am a believer of one shoe size does not fit all. Okay, and you've got very large economies, two of them particularly, and naturally currently the dollar being the dominant currency with about 62% of reserves in dollars and about 44% of payments, the impact of the U.S. monetary policy has some say in the global investment cycle. Now, the high interest rate environment, lowering the rates, perhaps one has to say there's an asset bubble that could be in the making if they go too aggressively. Now, that happened with the Silicon Valley Bank crisis in last year. Why? Because of ALCO, Asset Liability Committee, did not manage their long-term assets with the short-term assets. And same thing, the Federal Reserve had to manage it too. So there's a collateral benefit associated with each one. So I think one shoe size not fitting all. One should look at the regional economic patterns. As I said, countries and the world is more resilient today because of technological innovation, and they can adjust very rapidly. And I don't think the interest rate environment in the U.S. is going to have a significant impact positively or negatively, in terms of shocks to the system, because I think they've already been factored in by investors for long-term growth.
Well, you mentioned inclusive financing. What should we do in terms of South-South cooperation to further implement this ideal?
Well, the secret to this is technology. There are about 1.7 billion people around the world that don't have access to bank accounts. Mm-hmm. They're not included in the basic products and services, and the United States has about 6.5% that are not included. South Asia, there are about 85% of the adult population does not have bank accounts. Mm-hmm. So how do you bring them into the net to have access to basic remittances or payments services or paying bills? It's technology. And there are technological firms like Ant Financial. Look at My Bank in China has done increasing amounts of microcredit to bring in those people to provide small loans through technology. They can approve a loan in about 2 minutes to a small microcredit. So technology has provided the access for mobile payments, digital finance, digital payments are allowing these people to access those basic services. So that's where the inclusiveness comes in. And that's what we need to maintain and elevate that even more.
So Pakistan is hoping to join the BRICS cluster. What's the wider regional implication of that?
Okay, well, BRICS is a large trading bloc that has been formed. Keep in mind, this concept is nothing new. Mm-hmm. NAFTA was created in the Western Hemisphere. The European Union was created. So these are regional trading blocs, but this is more on a global level. Why? Because when the global financial crisis took place, that sent shockwaves around the world. As I mentioned, the trust in the international monetary system was shaken. And I was at the central bank, and we had to move very quickly to restore that trust. Now, to prevent that trust to be compromised again, banks have learned lessons. Central banks have learned lessons that to prevent those exogenous shocks, to temper their own region, they must develop regional blocs that would not be impacted by one country alone, so that there be balance in the world. Balance that these exogenous shocks would not impact on the common man. So these economic trading blocs will form a trading enterprise that will be relatively immune from those previous shocks that were felt by a unipolar world. It's a multipolar world that we're looking at, where the trade patterns are diverse. Keep in mind, the pandemic created supply chain disruptions that we're still facing today. And those kind of disruptions we need to be aware of. These are lessons learned. So BRICS is simply a response to ensure that the trading patterns of Pakistan and other countries are not influenced by shocks at the other end of the other side of the world. South Asia is the least integrated unit in the world. As I mentioned earlier, ASEAN is 24.5%, and US and Europe are 65%. South Asia, Central Asia region needs to be integrated. And there's huge potential there. Trade patterns from Russia down to south through India are already being formed. Trade patterns from Kazakhstan and Uzbekistan through Afghanistan, a transit route has already been approved and is operating through Pakistan. And China has also started, as you know, a couple of years ago, trading that route from China into Pakistan and into the Arabian Sea. So these are all patterns designed to prevent those external shocks from disrupting the smaller regional economies. So it's nothing sinister about this. It's just to develop economic models that can prevent shocks. And these are lessons that we learned in college and in the banking circles at private sector and public sector. So central banks have a responsibility, as a fiduciary responsibility, to ensure that their regulatory authority policies and their assets are channeled to the areas that are most productive for financial inclusion and sustainable growth.
Okay, so regarding the current geopolitical division in the world, you are on record saying climate change is probably the biggest denominator to forge, understanding and collaboration there. And could you elaborate on that?
Well, I mentioned earlier about the crisis that we face, but those crises pale in comparison to the existential threat we have to climate change and climate risk. And the common denominator that the two largest economies have is climate change. The United States and China both agree on that. Collaboration is the underlying basis of that. Now, capacity for alliance for sustainable growth to support this effort requires all the central banks and the financial institutions and the asset managers to come up with resources to finance the transition finance from a non-carbon based economy, fossil fuel generated economy, to carbon neutrality. That's going to take decades. Take Middle East, for example. It's fossil fuel generated, but it's going to take time. Where do you get transition financing for that? I can give you a small example. Mongolia is 90% is run by fossil fuels. They just launched a year ago a $60–70 million green bond with the support of IFC as an investor to invest in green projects. That is going on in China very aggressively, has been. One province alone is estimated at $2 trillion to finance the transition costs associated. So take a whole of China, it's going to be a multiple of that. Some studies have indicated $50 trillion will be needed between now and 2030. There could be a multiple of that. So where are these resources going to come from? It's mandatory we get our central banks, regulatory framework, and the collaboration of these two economies to mobilize these resources which they have in hand. How do they have them? In 2 or 3 areas. One, the 10 largest institutions in the world are Chinese and United States. They can leverage off their huge balance sheets towards that. You have multilaterals. The AAA rated World Bank, AIIB, etc. could use their financing to support this effort together, Hermes, COFAS included, and others. Then you've got the AAA institutions that are asset managers that have huge resources for their wealth management clients. They're waiting there on the sidelines. They need long-term investors. With lower interest rates coming up now, they're going to look at longer strategic returns. What is the likely source? Infrastructure. It's an obvious example. So those returns can be very well met for these socially responsible people that are coming into this area. Finally, how do you mitigate the risk with people who say, oh, governments change? Very simple. You co-finance with these institutions and governments change, but they won't default on these multilaterals and Exim Bank and others. So that's the area that I focus on, and I've sent a strong message to all the central banks to mitigate risks by using this method. Now, again, these bonds, for example, that have been issued, and there are more being issued, and even Pakistan, there's a green bond that was issued to invest in those alternative energy projects, aside from fossil fuels, wind power, solar, etc. That's what's needed in all these green financing, green projects, is to channel those assets and resources towards those kinds of investments as opposed to fossil fuels again, because that are creating pollution for the planet. And we as a nation, younger people, 20, 30, 40 years from now may not be able to breathe. Look at 10 years ago, Beijing was polluted. Today it's dramatically clean because 10-year effort has gone to clean up the cities. The 3 21st century cleanest cities are in China. Hangzhou and Shenzhen and one other one there. I visited, I'm going there in fact next 2 days from now over there for a board meeting. So that's the kind of collaboration that is needed between the 2 largest economies. And I underscore that collaboration will only do the trick in saving the planet for the future generations.